Good morning. What I'm going to do, and kicking off this finance and investment panel, is have each person give just sort of a brief self-introduction, and then I'm going to hand it off to Tim to kind of go into a little bit more of a deep dive and kind of big picture overview in terms of what he's seen in terms of the investment landscape. But Tim, and then Rick, and then Tony, please just kind of briefly describe your role.
Great. So I'm a stock analyst, follow the communications and cloud. I've been doing this for 20 years, so a broad range of the large carriers, AT&T, data centers, towers, some of the managed service providers. My background was more in the civil engineering, construction engineering side, so I feel pretty comfortable with the infrastructure side of things. I've been learning a lot more on the applications over the last kind of 10 years of doing this.
I'm, I guess in a nutshell, a child of immigrant farmers from Eastern Europe, and by fortune of education and experience, somehow I've managed to be associated with a lot of transactions in the technology, media, and telecom space for the last 2 decades. And I spent the early part of my career at Bear Stearns and co-founded with some colleagues a firm called Bank Street, which remains focused on the technology, media, and telecommunications and internet infrastructure arenas. Our collective experience spans multiple decades on average, and includes an experience base of probably $500 billion of transactional experience over the course of our careers. And we feel very fortunate to have the opportunity to continue to morph through what is a never-ending, changing, and very exciting industry.
So public markets, M&A, private equity. Tony, what do you do?
Yeah. Good morning. Tony Lynn from GI Partners. GI is a private investor in middle market asset-based companies. Most well known at this conference for investing in a number of data center operators, Digital Realty, Telex, Peak 10, and BioWest, to name a few. That's the private equity side of the company. I sit on the real estate side of the company, which is relatively newer but growing, where our mandates include a number of investment platforms, including industrial, multifamily, and again, most relevant here are technology advantage properties, mainly data centers, where we deploy capital under 2 mandates for 2 very large institutional investors across the U.S. and North America.
And I think you left out SoftLayer, which is now owned by IBM as well on the cloud side. So Tim, you interact with investors every day. What are you getting asked about most across all the different sectors that you cover, and what are some of the themes that you're talking about for 2016?
Well, first, I think this is a great sector. There's a lot of volatility, a lot of change in technology, a lot of regulation changes, a lot of changes to the industry structure. But there's also a lot of confusion. I got a call from a client this morning who's like, want to understand Amazon and what does it mean for data centers and fiber providers and the whole industry. And that's kind of a fairly typical call. I'm sure you get them all the time, Jonathan. And I try to start and pull back with investors, particularly if I'm talking to portfolio managers that are not really deep in the industry, and explain the long-term trends. To start out, because generally those long-term trends have been what's been driving the stocks over the last 5, 10, 15 years. And clearly everything's moving on to the internet. It's enabling the applications to become separate from the underlying network. And this in many ways creates a lot of competition and new entrants for the communications providers and cable providers. And when you have a more competitive industry, those industries are usually structured along more horizontally segmented lines. And companies that do real well are either focused on wholesale and infrastructure, or they're focused on enterprise sales and marketing with applications, or the consumer market. And I think the classic examples are kind of American Tower and Equinix, and more recently Zayo on the fiber front. On the enterprise front, it's something like a Salesforce.com. And clearly consumer, it's up in the air, but something like a Facebook is obviously doing, incredibly well. We see 5 components of infrastructure: spectrum, towers, fiber, the data centers, and the computers inside the data centers. Amazon Web Services has obviously the computers inside the data centers, but I frankly look at all 5 of those components a little bit more real estate-like, and the reason they should frankly be And I believe they should be, frankly, a form of shared infrastructure, a different type of financing, usually more debt financing. Usually, most of these segments are becoming REITs, so they don't have to pay taxes longer term. And the shared infrastructure just lowers the overall cost for the industry. And that really has been the key for the industry, is to be a low-cost provider. That's how you get, and if you are the low-cost provider with unique infrastructure or unique applications like Salesforce.com or Facebook, and there are many others with unique applications, you can get very, very high returns on invested capital. Luckily, Amazon, not a lot of people understood Amazon Web Services. It was mostly followed by analysts that follow the commerce side. So we tried to do a deep dive about 2 years ago on what the business model actually looked like and what it was valued at, and it was a pretty good anomaly on the valuation front there for a while. That's obviously gone away relatively quickly. So that's just the high level backdrop, and frankly, it's a very organic process. We don't really know what AWS means for the whole industry. But I do think they are stimulating an awful lot of competition, an awful lot of new applications, driving a lot of usage on the overall networks. We think, frankly, a lot of this has been enabled by mobile broadband networks. But the fact I follow 7 different segments of the market, I get questions on everything all the time.
So just spectrum being another pillar, and then I'll hand it over to Tony to talk about data centers. But there's spectrum auctions that are coming up. I think end of March, the broadcasters are giving up some pretty valuable licenses, and who do you see as participating in it, and any new business models or investments that you think are going to occur in the wake of those auctions?
Great question. I think the million-dollar question for the large carriers are, do the cable companies enter the wireless business? If so, how? Or even does Apple enter the wireless business as an MVNO? I think that's a key strategic question. So what we don't really know is if Comcast or the cable companies are going to aggressively bid for spectrum and try to build out on their own, or Google, or will the spectrum end up with existing carriers? And ultimately, I think if it does, I do think cable will enter the wireless business in some form or another. So we believe that T-Mobile will get acquired at some point by Comcast. I don't think the cable companies will be real aggressive in the auction, but it's a little difficult to tell at this point in time. But there are a lot of wild cards as Google show up. Sprint said they're not going to bid on the spectrum, but does a SoftBank affiliate bid on the spectrum? Because the spectrum is frankly most valuable for T-Mobile and Sprint because they need coverage and better in-building penetration to be more competitive. AT&T and Verizon do not need it as much. Google and Apple, we don't really know what their wireless strategy is going to be longer term. I'd be a little surprised though if they went and bought spectrum aggressively and built it out aggressively.
Great. So, Tony, a lot of data center M&As happened the last couple of years. There's some assets in the market, and any kind of broad read that you have in terms of both domestic and international perspective on what's being sold and what you've observed in terms of valuations.
Oh, sure. Well, I think I would start off by saying, in reflecting some of the comments that were just made about being the low-cost provider in more efficient deployment of resources. I mean, that's really the whole reason why we came to be, is that we started a platform that invested as a landlord in data centers, because what you're seeing in that space is, of course, things becoming more competitive, more M&A happening, consolidation happening, a great need for more efficient deployment of capital, and that includes also shedding capital from assets that probably aren't as productive in really the view of the investors of these companies. So the reason we came to be, of course, is that we invest in these data centers, and we can allow these operators to take that money that they would otherwise put into properties and put it into their own business. So I mean, I think what you'll see is you're certainly going to see a lot more consolidation. We've seen that over the last year and a half or so, including just a notable one that just happened a week ago that just finished up, the Equinix. But we're seeing more of them. We're seeing more international plays as well. And you're also seeing more combination of strategies where you're seeing wholesale and retail being put together, hence DLR and Telex. We see ourselves as the beneficiaries of that, but we also see ourselves sort of as, kind of the grease for the wheels of these companies being able to continue to grow in the way they want to grow.
So telcos in particular, currently are there was a wave where they were buying data center companies or buying hosting operations. There seems to be a little bit of a retreat going on where they're now divesting of some of the assets. Any perspective on who the logical buyer, what types of buyers that you would find? Would they be strategic or financial?
Well, I think you'll probably see more buyers like us out there, frankly. And you already do. There are a number of REITs out there, and I don't need to name a few. I think many people know who they are, that already invest as landlords in the business. Some of them operate and sell cage space or rack space, but others don't, like us. And so I think you'll see more of that. I think the focus of a lot of these companies at this point really is on more of the mature, sort of core data center play, where you have a strong credit company on the lease, and that way you can get the interest of major institutional investors to actually deploy that capital. But I think what you'll see more and more is interest in the sort of downstream, if you will, or just moving over on the risk spectrum towards more value add and even opportunistic plays.
Great. And then, either including data centers or moving beyond data centers on the M&A theme, any perspectives from your side?
Sure. Well, look, I think on the data center themes, it's interesting to sort of watch the waves that you identified with carriers of all different flavors sort of moving into the space in a big way about 5 years ago, and now seemingly about facing on strategies that weren't that long ago. I think part of the specialization that was just described is contributing to that in a meaningful way. I think there is a significant demarcation between those that are making very efficient the property aspects of the business versus those that are playing out strategies within these facilities. I think for a period of time, folks were beginning to think that carrier neutral solely was the strategy. I think increasingly you're also seeing that tested and challenged with folks that say, no, it's perfectly viable to have a strategy that combines a connectivity solution set with a facility. You're certainly seeing Zayo play out that thesis. I think some of the folks that are diving deeper into the interconnection aspects of these facilities are likewise, I think, to some degree enabling the carrier neutral capabilities. But both themes are today competing head to head and are viable in the marketplace. I think the next wave of activities will certainly see, I think, more refinement on the PropCo side, and I think you'll see assets get broken up among parties that maybe the actual large transaction gets done as a whole, but there's more efficient transactions that come into play after the fact, where it may be a strategic that prevails on what they want on the services side or the customer layer, but ultimately also make more efficient the overall play by bringing into the equation a capital source effectively, which is represented by the REIT world, that will make the transaction a much better leverage transaction, a much better return transaction for a party who doesn't have a return requirement that is a low single digit after-tax cost of capital, but rather a much higher return on investment. So it's probably daunting for a new player to figure out how to put traditional private equity or institutional capital that's looking for leverage returns in the teens or into the 20s in some cases, to have that face off on a bidding contest for a sizable asset with a party that has a cost of capital that's so different. I think those days are largely over. I mean, I think with very few niches, you'll see that come into play. To the question more broadly about M&A, I think the data center space will likely continue to play varieties of themes. I think the broadband infrastructure space that Tim touched on, which has many layers to it. There's a satellite layer, a wireless layer, and broadband infrastructure on the fiber side as well. Not to mention a massive infrastructure of enhancing more legacy type networks as well that will not disappear overnight either. And in all of these arenas, we're seeing consolidation continuing. We're seeing the capital markets, even with today's or recent weeks' tumult, likely to continue to foster and support rationalizing in these sectors to create more efficient, more effective, and more capable players in these spaces. And I think those people who sit on the sidelines during this window we'll find those that did not will be much better positioned for a longer period of time.
So questions anytime, happy to make a break, and we'll call on Joe shortly, but I do have a question about just continuing on the data center theme. Are you seeing any noticeable trend or increased focus on smaller markets? Everybody talks about getting content out to the edge. I think you cover Akamai, Tim, so you may have some perspectives on that as well. But I guess for all three of you, is the tier 3 and 4 market becoming more of a focus, or is it really the major metros where you're seeing the most amount of investment and M&A activity? So maybe Rick and then Tony and then Tim.
I'll kick off on that. I think what used to be called ghetto colo is back in vogue with effectively a new lease on life. I think the trade-off between processing power on the local basis and obviating the transport layer has crossed over. There is a real market opportunity, and it's being blessed and endorsed every day by what most notably the web-centrics and content delivery folks have been doing, which is literally deploying a lot of capacities into these edge markets, and it's given new business plans, a new lease on life with hundreds of millions of dollars, if not billions of dollars, going into companies that are deploying these edge networks or repurposing what used to be older facilities into this particular market opportunity. And you're seeing a lot of folks who had these secondary market assets actually streamlining both their marketing capabilities as well as their operations for more of these kinds of services. And it's not a tier 3 type of caliber in most of these facilities, but it's not necessary because the redundancies across these application layers obviate the need, and therefore is really creating a new lease on life for the folks that have these kinds of capabilities.
So personal view from me, I mean, and I guess I would underscore this by saying, what we do and what many of us in my business do is invest on behalf of major institutional investors and in pension funds. So the direction of that capital that you see is generally not towards the tier 3 locations. You'll see lots of investment in major metropolitan areas, and I think it's just simply reflective of the tension that exists between sort of new technology and old line real estate, right? And so old line real estate is one where you look at major metropolitan areas, you look at major centers of population, and that's where you put a core investment, a safe investment. And frankly, a lot of those areas now are being built out. So what I would foresee, and really this is my opinion, but you sort of see this in many other facets of the real estate business is, once you reach a certain point of supply or demand in these major metropolitan areas, then you go to the tier 2s, the secondary markets, or even the tertiary markets. Will we get there with the major institutional investors? Maybe not tier 3, but I could seriously see tier 2 being stronger in coming years.
Yeah, I'm not 100% sure what the business model looks like yet. I'm not sure. I mean, there's some thesis maybe we should be combining with the towers, and you have a small data center there to store immediate, really latency, sensitive things. And even Akamai would almost like to have Akamai software in every device out there in my iPhone, and they know maybe overnight when I'm sleeping, you update what I'm going to read in the morning, right before I wake up, or they would like to have it stored on many, many multiple layers. But clearly, we saw a lot of problems with exchanging traffic with Netflix, and we've had to develop much more interconnection points in the network to alleviate some of those traffic congestions. So that's been happening. But generally, to your point, I haven't seen a large company, really on a public basis doing it yet.
And I would echo that last point, that this is the world of innovation right now. So you see a lot of little companies, relatively speaking, in the arena, really finding the niches where they're bringing efficiency to the equation. So you have lots of folks dozens of folks deploying efficiency, burstability capabilities to accommodate some of these idiosyncrasies, particularly keen to the content folks and the large transport folks that are doing one location to many type of deployments, and or are event driven, which tend to burst traffic patterns in particular ways and processing patterns in particular ways. I think also the bridge between legacy approaches to transport and to processing capabilities from a centralized data center, which may be the tier one purpose of a company, in some cases even housed in that facility, with a particular event that they're doing or launching, you suddenly find a cloud application that needs to complement that. You need a bridging capability to do that on the network side too. So in all of this inefficiency layer is the new innovation opportunity, and we're seeing a lot of folks taking advantage of that, and you're seeing some rapidly growing companies taking advantage of, in many cases, not deploying their own infrastructure, but creating abilities, whether it's through portals or through automation, which in many cases link through APIs to larger platforms, suddenly enabling capabilities to do all kinds of very interesting deployments.
So I think we had a question up front, Joe.
Yeah, just two recent telco announcements. Does the sale of quote-unquote data center facilities represent an attempt to boost return on investment capital through sale leaseback? And if that's the case, why aren't they also getting rid of, let's say, office buildings or switching control centers? And if it's not, does this represent the capitulation of network operators to a large extent in the cloud, and basically it's the beginning of the end for them in phase two?
So the question really related to kind of the telcos selling their data center assets. Is it simply just kind of a source of financing, and if so, why not sell office buildings and others? Tim, you cover two of the largest telcos out there. Maybe you can kind of take a stab at that, and then Tony is the potential financial counterparty on some of these. Maybe you can provide a perspective as well.
Well, they've done it with the towers already, and it was both financial and a little bit operational. They've done a little bit with office buildings. They would do it with central offices, I think, if they could, to re-engineer. And the networks are going to be rebuilt in very, very different ways. But it's very financially efficient. It's tax efficient to do with sell lease back on these. But the other honest truth is when you visit a telco data center versus someone who just focuses on data center, the focused data center operator is just innovating so much more rapidly, and it's all they do day in and day out. And I think they've just been pulling ahead of the telco data centers from a quality, capability, service perspective, over the last 5 years.
And I would say, with regard to the sale leaseback situation on data centers, certainly that's happening, but that's always happened in the office space to a certain degree. And so I think really what you're more or less seeing is companies sort of reflect the way that they treat their hard assets on their balance sheet, consistent with the way they own data centers. As far as whether that validates more movement to the cloud, that's a little bit harder to say, because I think depending on the operator or the company, there's always going to be a need for security, and the question is whether people feel secure enough to actually put their data onto the cloud, or whether they're going to want to hold it in their own facility that they know they can secure on their own terms.
If I could piggyback on Tony's last remark, there's always this tug of war debate that goes on about, hey, is this the eradication of one for the other? I actually feel pretty strongly that there is a place for a variety of different types of facilities, including the cloud layer, and I think the degrees to which flow of activity is in motion in one direction or the other may vacillate from time to time, but I think we're long from done on centralized data center capacity as well. I think the telco maneuvers of late probably is more motivated by the realization that there's not a lot they can do to enhance the physical property layer of the data center-centric services activities that they're doing. So from that realization, it is a easily monetizable asset with somebody who probably, in some respects, is willing to value it more than it is going to be valued hidden into the balance sheets of a major telco. I think an interesting observation about the most recent announcement is Verizon keeping the cloud services layer as part of their own integration or portfolio of services. And I think that's a testimony to the fact that most of the major telcos, and even some of the not-so-majors, are still trying to figure out the layer of services offerings proposition that is the right one for the next generation. I think many are playing out optionalities. I mean, Comcast was mentioned earlier. They are doing it in the form of partner relationships. They haven't actually internalized very many of those capabilities because their view is they don't really know the adoption cycle or the blended portfolio necessity for a lot of those services to their type of customers, which tends to be a pretty small customer at this point. So I think we're in the early innings of what the portfolio will look like for a lot of these companies, but I think you should see, as was mentioned, we've seen in towers, you'll see in more PropCo type deals. I think the colo facilities, candidly, in many respects, represent a fantastic opportunity for edge data center deployments. They're highly interconnected facilities with the caliber facilities that are well situated for some of the kinds of things we were talking about earlier. But how that all plays out, I think, is still to be determined.
But I would just add on the cloud services side, I think AT&T has shifted focus to more on their net bond and networking and partnering with cloud services where, and I think even Verizon with Terramark is shifting a little bit upmarket, the government of very large specialized, cloud projects. CenturyLink is obviously still in business, but it's still very early to your point. It's not really clear how it's going to shake out.
So not to harp on this point, but I guess the real question maybe is what was the defining event or trigger where they all woke up the same morning and said, let's knock this stuff in, right? Was it Fed moves or just a realization, I don't know, AWS results, or they all have to be having lunch together? Like, why did they, it's not just like random,
That's right.
sort of natural, we're looking at our balance sheet and okay, this facility is unproductive, let's do this, or, you know what I mean? Like they all of a sudden decided to do it.
Well, they do need about $10 billion each for spectrum coming up, so that's helpful.
So the question is why now, and why is it a coincidence that so many companies are considering asset sales? And Tim brings up a really good point. Spectrum is going to be a multi-billion-dollar check that gets cut. So we do have a question in the back.
Sorry, just following up on Tim's comment about the $10 billion for the spectrum auctions. I wonder if we can get the panelists' projections on how much spectrum will be cleared in the upcoming broadcast incentive auction and the average price per megahertz pop that will be paid?
I'll take a stab at it just to give Tim a break. So I mean, my baseline projection is $1.50 per megahertz pop, and in any given metro, somewhere between 60 and 80 megahertz total. So including the 30 megahertz reserve, would be available for bidding.
That works out to around $30 billion. I'm a little lower than that. I would say it's going to be more like $20 to $25 billion auction. But it could well go to $30 billion. So I'm around 70 megahertz at $1.25 megahertz pop is my best guess right now.
Mm-hmm. So we did 2 questions that came in through the web interface around telcos that are related. So are there any new exciting prospects for the telcos, and then maybe related to that, do telcos have to expand their product portfolio to keep growing? And I'll maybe ask Tim to comment on CenturyLink versus Verizon versus AT&T. AT&T, it strikes me as going south of the border for some of its growth. Verizon's kind of focusing on wireless, and they're both trying to, maybe make more inroads in the enterprise. But what's your take on that?
I'm going to answer this in a slightly different way. I think all the new cloud technologies and software-defined networking technologies are coming out. AT&T produces $15 billion a year of free cash flow right now. I think they can reduce expenses by $10 billion a year. And if I was them, that would be my focus, primarily, deploying all these new technologies. I think on the video front, though, they are trying to use DirecTV for someone like me, where my daughter at college, she just logs on and watches TV through our Fios TV and DirecTV. They're trying to create a family plan, a family package for television, which is a reasonable strategy. I think Verizon is trying to, with Go90, they're trying to set up a platform to attract other application providers to use their wireless network and their wireline network to a certain degree. They have a media delivery network, but that doesn't seem to be working out, real well yet. But we can talk about, obviously, these items for hours, and Rich probably has your view on it.
The fascinating thing about this industry is we literally could go down every one of these micro channels for a long time. There's a lot that is afoot in every subsegment of this industry. To the earlier point about what's the timing of some of these actions and waves of actions, let's also not ignore the fact that many of us on this platform are talking to many of these companies about moments in reality. And late last year, when probably many of the planning cycles for data center sales and so forth, there's the consumption side, which is we have capital appetite and purpose, which is profiled with a certain return profile. And we have these assets that at that moment in time we're trading at record values, premised and correlated very heavily with the interest rate environment. And we're large in scale and highly commoditized from the point of view of what they have versus what other large, similarly situated, more focused players in the industry do with these assets. And it's a bit of a common conclusion, because a similar thought process probably plays out in each of those boardrooms that are similarly situated. And some of us bankers have a habit of saying, hey, those guys have a reason to do this and they're going to do it. By the way, you have the same reason and the same, and it doesn't apply to every player, but strategy-wise, to the degree that you likewise have a big capital need and have an orientation that's similar, then you could see a similar motivation. It's not that they just wake up and they have the herd mentality entirely, but the bells go off and say, all of this checks, and it makes a lot of sense to deploy or redeploy essentially capital that's tied up in an asset that you're not going to be able to do something terribly better than flipping it to people who have a capital efficient model to focus on that particular ecosystem and keep the service layer that you want, keep the customer base as you want to, integrate it into your portfolio, custom tailoring the requirement for both sides, and enabling you to go put money to work in faster growing spaces that enable you to remain competitive and keep your valuations as high as you can.
So I'm going to wrap up one final question from my side, and to kind of fold in some of the themes that we've been talking around: cloud, SDN, software-defined networking, OTT. Tim, you just mentioned it, and probably more for the two of you, but Tony, you can feel free to chime in as well. But how do you see that affecting fiber-based business models, whether it's subsea cable, metro fiber, long haul, dark versus lit? And you got maybe 3 minutes between the two of you to maybe chime in on that.
I'm going to be real quick on that.
Yeah.
I think fiber is the next shared infrastructure. We've had towers, data centers. I think there's very, very strong demand for fiber. Fiber has to be built to new locations, to small cells, to these large mega data centers, to other interconnectivity data centers. And frankly, if you look at a Zayo, they traded at like 9 times EBITDA. The REITs, and Zayo could become a REIT over time, trade at 15, 16, 17 times EBITDA, and Equinix is at 15 times. They used to trade at 8 or 9. So I think for investors that have a 5-year opportunity or outlook, that are patient, that could be a very, very good investment.
Yeah, look, I think the REIT paradigm has its trade-off elements that you have to consider. I mean, it's a phenomenal arbitrage in a lower interest rate environment. May not play out quite as well or as effectively in a different environment, but I think to the fiber and future services arena, I think this conference in many ways reflects the changes that are happening. I mean, the participation at this event, probably from CDNs, software-defined or quasi-software-defined networks, and many integrating and interloping parties. I would also actually suggest that Tim's forecast is also the current realities, which is many of the largest deployments of fiber infrastructure, whether they're terrestrial or undersea or whatever flavor, is actually being done in some degree of syndication. And whether that partnership is with a municipality or with another carrier or a joint collection of carriers or the web-centrics or commercial customers combined with a fiber developer, I think that efficiency is going to remain the status quo, and I think the pervasiveness of fiber over the next 5 to 10 years is going to be very, very significant. That has a lot of implications for satellite players, wireless players, the complementarity between those ecosystems, and I think it's going to be a wonderful consumer and enterprise arena in terms of the enablement that's going to come with that. And all of the folks that are over the top, that many of whom are also circulating at this event, that are trying to figure out how to enable the things they want to do, are going to have a wonderful environment to do it in. So I think there's a lot of optimism in terms of how people are going to play in this ecosystem. I think the place where there could be some pessimism is anybody that's in legacy minutes, whether it's over a wireless network or a terrestrial network, is under dramatic assault. I think anyone who's in a commodity bandwidth segment of the marketplace is going to have to continue to get adjusted to the fact that that layer by itself is not going to be a layer that is going to be easy to sustain high IRRs over the course of time when the cost of capital of the players that are encroaching into it is increasingly lower. So I'm getting a big stop sign here, and
Yeah.
I'm sure all of us are welcome to you to talk further or speak with you and your companies over the course of time at your leisure as well.
Yeah, thanks very much for your time. Great panel.
Thank you.
Nice to meet
Thank you.